Hi, everybody. Good morning, good afternoon, good evening. Welcome to Power of Knowing Forum's LinkedIn Live podcast, episode 106. Today, we are having a discussion on the future of carbon markets, innovations, trends, and shaping sustainability. We have the honor of having Hirander Misra, Chairman and CEO of Gemex Group and 013, award-winning speaker at COP23, World Economic Forum Davos speaker on climate, fintech with top 5 ranked sustainable news, most influential CEO 2024 UK carbon credits. Without further ado, let's welcome Hirander Mishra to our podcast. Hi, sir. Good evening, good afternoon.
Yeah,
Welcome
good
to our
afternoon. Good evening.
podcast.
Thank you.
How are you today, sir?
Very well. I hope you're well. Looking
Yeah,
forward to the podcast.
sir, we'll dive into the topic today on the discussion of future of carbon markets, innovation, and trend shaping the sustainability. Sir, how effective are carbon pricing mechanisms in actual reduction of emissions?
Yeah, I mean, pricing is the $1 million question, so to speak, because at the moment, there's no standard level of carbon pricing. I mean, even for individual carbon credits that result from methodologies relating to solar, wind, regenerative agriculture, or even other sorts of carbon credits. So at the moment, there's a lack of indexation, but also because a lot of the market is over the counter, then typically what you and I see in other commodities markets in terms of indexes, in terms of forward pricing curves, doesn't necessarily exist. That's not to say that's a bad thing, but it's a real opportunity, to work together, leverage kind of electronic platforms as well as over-the-counter data, and create some of those benchmarks. There are a number of them, but it's a process that's undergoing improvement, which also leads to some inefficiencies in the market, which we'll touch upon as well shortly, I'm sure.
Yeah, we'll dwell on it, sir. What are the social economic impacts on carbon pricing on different communities, sir?
Yeah, so I'll give you an example that I came across, which was very interesting. It goes back to the first question around carbon pricing. So we did some trades via our 013 ecosystem recently that were animal waste to energy trades, think biofuel, from Gujarat in India.
Okay.
And it's interesting because those credits are generally available between $2 to $3 a carbon credit. Obviously, 1 ton of carbon equates to 1 credit. Now, a broker in London was buying them at that level
Okay.
and selling them to another broker for £7. That
Oh.
broker was selling them to its client to reduce scope 3 emissions for £9. So let's call it $12. The
Okay.
community-driven project was only getting $2 to $3, yet the carbon credits had changed hands multiple times at a value far greater than that and a multiple of that. Now, what's the impact of that? The impact of that, because of lack of transparent pricing, is those communities that are doing the projects get less capital, but equally projects that could be economic now uneconomic because the right price for those credits isn't being garnered in the market. And this is where transparency, doing things, harnessing electronic platforms such as what we have, harnessing blockchain from the supply straight through to the demand, are very, very important, because as we get that transparency, there's going to be a more equal distribution of wealth across that chain. It's not to say that brokers are bad. Actually, there's some very, very good intermediaries and brokers in the market. But it also means that, again, to operate, you have to really add value. And ultimately, the bulk of that capital should be going back to those communities. And you're on mute, I think. Hi, sorry, you're on. I can't hear you.
Sorry, I was on mute. Are you saying that there is no global standard as a pricing at the moment, sir?
Yeah. So there's a multitude of standards on the supply side, in terms of measuring, reporting, verifying, and a number of registries. You have Vera, you have Gold Standard out of Washington, DC, but there's also newer digital registries like Carbon CX that we're working with out of Calgary, and obviously existing other registries like Universal Carbon Registry out of New Delhi in India, and Global Carbon Council in Qatar as well. So there's a number of different players, and of course governments are looking to set up national registries as well. The UAE one, Kenya is another one where the regulations have just come out as well. So bearing all that in mind, one, there's fragmentation because there's multiple standards and registries. Two, there's a lack of standards on the market side as well. We take the approach there's got to be a menu of standards that you incorporate into the platform, or platforms, and then the market can choose what it wants to do on the supply and demand side. So, for example, one of the things we did last summer as 013, we executed trades on India-based carbon credits relating to again waste to energy and solar, and we did those against the International Swaps and Derivatives Association voluntary carbon credit standard. ISDA, as it's shortened by name, is very, very important because corporates and banks use a lot of ISDA agreements for things like interest rate swaps, and there's a lot of trust in it. So what we did was we made those agreements electronic so that could trade with each other using those such agreements, which also then means there's more trust in the standard. That will also then help drive, together with the data that I mentioned, where we can build out, indexes and forward pricing. Having a standard that underpins that will also help drive adoption, which is good for the market, of course.
Sir, as you said, how can this global pricing be implemented globally, given the difference in economic circumstances across countries?
Yeah, it's interesting because, we speak about a plethora of standards, but equally there's no global standard carbon regulation. But there again, that shouldn't be surprising because if we look at things like banks or exchanges, there's no such thing as a global bank or a global exchange. Of course, that there are high-level international principles, whether it's IOSCO on exchanges and market infrastructures, but really you have to get regulated in every jurisdiction. So what now is, Kenya is introducing its carbon regulations, which it's just introduced. You also, at the level of UAE, have the Financial Services Regulatory Authority at Abu Dhabi Global Market. They have carbon regulations today. And then a number of other countries are looking at both compliance markets and voluntary. Broadly, that's okay. But, again, at COP28, where, we won an award as 013 in November into December last year, IOSCO also came up with principles for voluntary carbon credit markets. A number of countries are looking at both compliance markets and voluntary, India being one, from a policy perspective. So in that sense, there are always going to be a multitude of regulations, but actually one thing's for sure, or highly likely, I would say, where recently in the US, the Commodities Futures and Trading Commission, came up with the notion that carbon credits are likely to be intangible commodities. And Singapore as well came up with a similar notion as well. So ultimately, a lot of what you and I know on commodities markets will come to bear in carbon markets as well. I mean, it reminds me, I had a conversation yesterday with a gentleman that was in the power markets in Europe from the 1990s. And they were very disorganized markets with different levels of delivery as well, depending on generation and delivery of power as well. And those markets organize themselves as well. And many people said it wouldn't be done. The same will be true of carbon markets also. Everyone makes a big point, and there's a question as well from the audience that 1 ton of carbon should equate to one credit, and irrespective of whether it's carbon dioxide removal credits or whether it's a solar methodology or wind. But ultimately, the biggest problem is provenance and trust, because the price of certain types of credits could vary markedly, and it's all about more or less trust in certain types of credits. So digitalization is going to enable high integrity credits, which is also going to lead to a better price, which is also then going to lead to price convergence when we get rid of junk credits in the market also.
So I have one point from Neil. He says, isn't 1 ton of carbon equal to 1 ton of carbon, no matter how it was generated? So this is a question.
Yeah, just going back to my last point, absolutely. Ultimately, we can get to that, even though then there'll still be a multitude of demands. So, I mean, there's two types of players. There's those that are buying because they emit to retire credits, let's say looking at the voluntary market. And there's also those that want to get into this asset class. But, if you're an investor, one, you want a diversified portfolio. Two, you don't necessarily know how you can go and buy and hold a carbon credit as well, and what the mechanics are. And that's where we've also been working with issuers to create investment products that allow that kind of portfolio-based approach, like the world's first structured products that are exchange listed, and also beyond that. So ultimately, as trust builds in the market, yes, one ton of carbon should be equivalent to one credit, and there should be price convergence. I think there'll always be demand for certain types of credits from certain types of organizations, but we'll certainly move towards a direction where the World Bank and the International Monetary Fund have highlighted that they want to see over the next few years the price of carbon credits get to kind of $85 a credit, so $85 a ton. And certainly, as a big step up from where we are today. Plus, there's a disparity between Western credits and those in the global South also, which, again, working with technologies and enabler, we can address.
There's another question which is come. In Tanzania, how can I involve in carbon market? On Hassan Maru is the question that I have from Hassan Maru.
Yeah, it's interesting. I mean, the Tanzanian government are also looking at carbon markets, as are the Kenyan, Ugandan, Zambian governments. It's interesting, even ahead of that, we've spoken to project developers in Zanzibar. Yesterday, we spoke to project developers on carbon removal credits, that have high integrity projects, working with communities to plant new trees in Tanzania, in Uganda, in Kenya. So really, it depends on what perspective of the market you're looking at. If you're a project developer, certainly there are existing projects both in Tanzania and offshore in Zanzibar as well that are being undertaken. If you're a carbon and as a project developer, even ahead of Tanzanian carbon regulations, you can register those credits internationally in international registries, and they can be sold through platforms such as ours into a wide array of participants and exchanges. But so really depends on the perspective that he'd like to get involved in the market. But there's certainly action in Tanzania right now.
Okay. What are potentials that unintended consequences of carbon pricing, such as carbon leak?
Yeah, so by carbon leak, just for the audience, I mean, what it generally refers to is, some degree of arbitrage, right? Where production of high emission raw materials into kind of industrial output moves from countries which have stringent regulations to those countries that have less stringent regulations. A bit like companies moving to low tax jurisdictions or booking activity. So where there's an arbitrage opportunity, then organizations, individuals would always take advantage in the near term of arbitrage. But here, actually, it's interesting because as we move forward, the eyes of the world, whether it's as individuals or organizations or investors, is increasingly on companies. And that also leads to some level of questioning, and also with more and more data out there, these things are always readily assessed or more easy to assess than before. So of course, companies may do that, but really, investors, whether it's consumers or other wholesale buyers of products, will also end up voting with their feet as well. And at the same time, this is where international standards and regulations come into force. So regulations, even if they're local, but international standards are important. Like the work that IOSCO are doing or ISDA doing that we mentioned, obviously at their own levels, the World Bank and others, the IMF are working as well. But also recently, a few months ago, I was in the United Arab Emirates, where there was a workshop run by the Ministry of Climate and Energy on carbon dioxide removal credits and standards. So I think there's good work going on that will help address this.
Uh, we've touched upon the markets and how they can drive environmental impact. But what are the future market trends, innovations, and uh, trends that shape sustainability?
Yeah, so one big problem, I'll describe the issue, then I'll describe kind of how that can be solved. So one big problem is, and I've written a blog on this recently, the
Okay.
centralized exchange model doesn't work for this type of asset class. And I wrote a blog where I said there's limited liquidity on voluntary carbon markets across the globe. Now let's explain this. So the project finance might be in large financial centers like Singapore or London or New York, for
Mm.
example. The carbon projects that need financing may be in global south countries like Kenya or like Zambia, for example. The projects, even if they're then financed, the output from those, the demand might be from oil-producing countries like Saudi Arabia or like United Arab Emirates or Qatar, who want to carbon offset, or in terms of Qatar Energy or others. So the model is very distributed by its nature, which means that the only way this can work is a distributed model, whether it's using new technologies like blockchain, also on the data side, because high quality is very different to high integrity, because the key is high integrity, but this is all about source data, because carbon credit essentially is a piece of thin air, right? So how do you know this piece of thin air is valuable and this one is less valuable? And this is all about source and provenance data, which now using blockchain you can build into smart contracts, and it's available all the way through the life cycle, including then the transaction happening downstream, whether it's over the counter between you and I or on exchange. But that immutability becomes important. Now, the problem is everyone speaks about blockchain as one ubiquitous technology. So we've established that a distributed model is very important for these markets, given the nature of global regulations, global flow, global financing. Really, everyone speaks about blockchain as ubiquitous. Yet there are multiple blockchains, and
Yeah.
API going away, because if you look at Swift or you look at open banking, it's API driven. So it needs an approach that's interoperable across APIs and also across multiple blockchains as well. And this is something we're firm proponents of, even as 013.
Okay. So we've touched upon blockchain. How can blockchain and other technologies improve transparency and integrity of carbon markets? Is there a play that blockchain can play bigger on the technology front?
Yeah, and just touching upon the question that I've just answered as well, this one's important because with blockchain now, you can source data that's immutable, whether it's data that's collected via satellites, via drones, via on-the-ground sensoring, via industrial carbon measurement, or commercial efficiency data from commercial building energy efficiency or solar, because you can work backwards from the energy created. A lot of this now is measurable. Increasingly, we have the tools, whether it's using Internet of Things or AI, to be able to not only measure, but to apply analytics and regenerative AI to this data. Now, blockchains are only as good as the data coming into them. Otherwise, it's garbage in, garbage out. So whether it's centralized or decentralized oracles, the blockchains need trusted, high integrity data. So again, the source problem at the data level can be addressed in the manner that I've described. At the same time, that data then can be sort of combined into smart contracts, and then the whole life cycle of the carbon credit from source all the way through to sale can be tracked. A bit like food, where we've lost connection with our food from farm to fork. Yet supply chains linking to the demand side becomes key. So I think we're increasingly going to see a lot of that. We've recently undertaken some projects. We're recently working with mini grid solar developers in South Africa, where mini grid solar power by its nature is decentralized. We've executed that using smart contracts with Polygon blockchain into our layer 2 blockchain that's on Cosmos Tendermint, 013 chain, and we've proven end-to-end provenance using blockchain and smart contracts across multiple blockchains.
Going further, what role can voluntary carbon markets play in complementing regulatory markets?
Yeah, I mean, it's interesting to know that for the audience, that they're two different constructs, right? Because if you look at compliance markets, it's governments issuing certificates for allowances and how much you can pollute, and obviously, if you want to pollute more, you buy from someone that's polluting less and has a surplus, right? A bit like a few years ago, I was involved in the committee for Clean Ganga, and there was a similar thing with water credits, polluting the river as well, and the Ganga River, in terms of how that could work in a similar fashion. Yet, voluntary carbon markets, by the very nature, it could be emitters like the oil companies now saying, okay, I'm going into green energy, like many of them are, as part of a decarbonization strategy. But at the moment, I'm most of my production and most of my commerce is on fossil fuels production. So I can buy high integrity voluntary carbon credits, and by virtue of doing that, I can offset my emissions because that money then goes into projects that are very, very valuable. And so you've got a number of emitters buying voluntary carbon credits, whether it's on a forward basis, notwithstanding some of the difficulties around forward pricing that we've mentioned. That brings capital into projects that can then be developed, that then deliver on those forward credits, but could also deliver a surplus that's then sold in the market as voluntary carbon credits as well. Alongside then, now there's something interesting called internationally transferred mitigation outcomes, or IPMOs, where governments under Article 6 under the Paris Agreement are negotiating deals where government entities or private entities are endorsed to buy, and others that are endorsed in terms of their projects that are IPMO approved can transact. So, Singapore recently announced that it will be undertaking IPMO transactions with Ghana. There's also something I read today that where there's negotiations with Switzerland and Kenya as well. So those bilateral negotiations are very important as well, although albeit a lot of them are manual, and technology can play a part there, such as trading platforms that are distributed, like I mentioned, that we're involved in.
Yeah, I have two people joined. One is Uday and another is Sanil. I'll bring them onto the screen to ask question. I'll bring Uday first onto the session. Uday, hi. Good evening. Can you ask your question, Uday? Hello. We cannot hear Uday while I'll bring on Sanil. Sanil, can you ask your question, please?
No, I didn't have any questions as such. I work for Hirander, I work for GMEX company, so I've got the link, and I've just wanted to join in and listen to you guys, what you've got to say. Interesting, so partly is what Hirander is saying. He's on the front line of I kind of agree with what he's saying. There's a huge carbon market out there, but yeah. So the purpose of me joining is just to listen in. That's it.
Sure. Okay. Anything, just ping us on the chat. We'll bring you up onto the screen again. For now, we'll keep you on the member mode. Okay. Going further, how can carbon markets be designed to ensure inclusivity and benefit developing countries?
Yeah, so this is a big challenge that I mentioned, where there's a massive differential in Western credits and those from developing nations. And actually, there's an age-old adage where, if you look at potential EU taxes on emission countries and other things, these countries are saying, well, the West went through the Industrial Revolution, and now it's our turn as well. So why shouldn't we develop? So in that sense, there's got to be an equilibrium here. Of course, countries, whether it's countries in Africa, Southeast Asia that we speak about, obviously need to develop. The biggest problem is, the World Bank, the World Economic Forum, others have highlighted there's differing numbers here. but there's a multi-trillion dollar annual financing gap, which means climate finance isn't getting to the projects to the extent that it needs to and as fast as it needs to as well. And so one of the challenges, and we're always very much involved in this, and we'll also be launching an investment facilitation platform within a month, is how do we channel both us enabling and network of networks, connecting to other financial capacity money into projects. A lot of the time when we look at those projects, some are very good and bankable, others need a lot of work, and so we always look at that lens. Channel, who's on the call, as a team, there's projects around cook stoves and other types of carbon credits, again carbon removal ones as well, that we've looked at just to refine. So I think again, with some of the engagements we have, whether it's in African countries or otherwise, we always say, look at it with the lens of an investor, but at the same time, we can all work collectively to build that capacity. And the point I made about differential in pricing, with using technology and transparency and better distribution, we can close that pricing gap, which will also bring capital into those developing nations.
So what are the potential risks and benefits linking carbon markets globally?
Yeah, so benefits are obviously, if the markets are fragmented, what technology fragments, it can knit together. And when it's knitted together and you have a number of registries, exchanges, participants, and even services like carbon calculation, ratings, and the like joined up together, it will allow us to be able to garner services that you really need. Because it's a bit like, let's say now you use a carbon calculation service. You'll say, okay, I have emissions, but now I need to buy voluntary carbon credits to offset them. Now, where do I buy? How do I buy? What's the process? All of this becomes easier as we provide tools that are available out there that are widely encompassing. It's one of the missions that we have as well, because then all of a sudden, we're, as individuals or even as organizations, we're creatures of habit. We don't want to use lots and lots of systems, and we'll generally go for the ones that are convenient as long as it can kind of meet our objectives. So we're going to see a lot of convergence between finance, fintech, and climate fintech as well, where because a lot of the time you had climate technology firms that are on one side, climate fintech or fintech firms on the other side. Now, climate fintech is really that bit in the middle, and that's something we're firm believers in, again, as 013.
So what we touched up so far, how markets can drive environmental impact, then innovation trends and shaping. Going further, how can individuals' actions contribute to global change and how individuals can incentivize to participate in carbon markets?
Yeah, it's a very interesting question. So, now over the last few years, I've been thick on the sustainability side, and I always question, what I'm doing. Food takes water and energy to produce it, right? So, food waste is a lot of wasted energy, a lot of wasted water, and other things. So, at an individual level, we can question how we live. I mean, it was interesting. I mean, last week at HSBC, I was on a panel at HSBC China Connect in London to celebrate the Dragon Boat Festival. And it talks about how these ancient communities, everything they did related to the soil, related to the water, related to seasonality and how they lived. So I think one of the things that we can do is question how our food is flown in, or become more regional, because we reduce the carbon footprint on what we're eating. We've been used to creatures of convenience. We go to the supermarket and everything's available on demand, yet it could be in thousands and thousands of miles. Also, there's an interesting link where we did some work leading up to COP28 that we're expanding upon, where companies wanted to get closer to their consumers and show that there was climate action going on. So instead of loyalty, where you earn loyalty points, and those loyalty points can be spent on benefits or discounts, then can offer loyalty schemes that provide consumers with loyalty points that consumers can then allocate to community-driven climate projects. And all of a sudden, as a consumer, you can be empowered to then allocate capital into certain types of projects or individual projects by virtue of the company doing it, but by virtue of your spending. Equally, we can choose with our feet. So, if we think organizations aren't particularly green or climate friendly, we can choose to buy from organizations that are more climate friendly as well.
What are the impacts of personal carbon footprints on global emission reduction targets?
Quite high. I mean, if we look at one of the big emitters, if we look at it, is real estate. It can account, looking at different numbers, but just rounding up the numbers, it can account for about 20% of global GHG emissions annually, right? Now, if we look at that, commercial real estate accounts for 7 to 8%, right? And the 12 to 13% is residential real estate as well. So if we take that in mind, the homes that we live in, given the energy usage that we have as well, in the most part, are big carbon emitters. So again, notwithstanding what we're purchasing as well, there's interesting applications and things coming out which allow us to track off our carbon footprint, a bit like food apps that allow us to track the number of calories we're consuming. So it's got to be much more than, you get on a flight and an airline goes, okay, offset your carbon emissions. But the problem is when you click on that, the apps might not be that good in the most part. But the other part is you have no idea where the money's going, that you're using on the flight, or even if it's at the right price, right? So, we're encouraging airlines to be more transparent with that as well. And certainly we have a solution for that. But equally, I think it's going to become commonplace. I mean, much like in the UK where I am, there have to be nutritional labels on food that's not prepared on site, and that shows a level of fat content, sugar, and other things. As carbon accounting rules come in Singapore in 2025, other areas, companies' green activity versus it's not so green activity is going to become increasingly more apparent, which will allow consumers to choose, but also change their own behavior at the same time.
I have a few questions from Neil, which I'll bring it up one on one. So, first question over here with Neil is junior high quality credits are key. That's the pointer he's mentioning. The second pointer that he wants to is how can countries required by law to buy credit to offset their pollution?
Yeah, so the first one, I mean, to me, there's a difference between high quality and high integrity, because high quality doesn't necessarily mean high integrity, but either way, whether you have one view or the other, it all stems back to trust, and trust stems back to that source problem that we spoke about and addressing that end to end as well. And certainly, in terms of what we're doing, that's core to what we do, because you've got to match that supply with provenance through to demand, and make sure there's interoperability and interconnection with that. Now, the question on laws is interesting in that, yes, I mean, certain countries are mandating that with the regulations that are coming out. They're also mandating that project developers that benefit from carbon credits or that are involved in it also provide some level of carbon taxes that go into the state, because if you look at this, certain projects can be very much commercially driven, but there's also community-driven projects or not-for-profit projects or capacity building that requires maybe donor funding or state funding. And obviously, state funds in these developing nations are very, very limited, given the capacity of treasury, and given some have a propensity to have debt or debt in place. So certainly regulations in Kenya are coming in to address that. That brings capital in, but it also gives the state some revenues and creates that virtuous circle. And there's certainly regulations mandate that at the project development level, at the buying level, things have to happen through that regulated construct. So certainly we're beginning to see change. Obviously, it varies country by country, but generally as one country implements it successfully, others naturally follow because they can see tangible benefits. One of the things there that we're seeing, which is a huge opportunity, and I said this on the HSBC China Connect panel last week, as you start to value these instruments or even securitize them or reflect them on balance sheet with a value, you can start to you can start to reflect their value on balance sheet and lend against them and do other things that we do with vanilla assets. Like, for example, we did some research in Tamil Nadu in southern India recently, and 50 megawatt wind projects, carbon credits could account for 25% of the ROI over 20 years. Yet financiers would discount the financing to zero because power, obviously there's power purchase agreements. Yet they were saying we will lend nothing. So as you start to value these and you start to have pricing, even if there's a risk weighting and you might lend 20% and then over time 50%, we'll start to bring more finance into the system.
There's another question which Neil has, so I'll bring that as well. So solar panels are big polluters at birth, yet they can generate carbon credits. Shouldn't the credits only be applicable once their embodied carbon is at zero, say year 8?
Yeah, it's a very good question, and there are different methodologies and there's different views. Now, at the same time, the solar panel producer, because of production, has emissions, right? And certainly that should be transparently offset and case in point. And then those buying the panels as the project developers, what they will be doing is they'll be replacing, let's say, fossil fuel driven energy with greener energy, and there's a delta on that in terms of the energy replacement, and roughly, if we look at Indian solar credits, and it could vary generally, but this is data from registries, 1 megawatt could account for 15 to 1600 carbon credits per annum, and so if we look at that, yes, absolutely, there's the whole chain, but this is where supply chain transparency becomes important, because there's different levels of emissions, scope 1, 2, or 3. And the project developers, mini grid solar we're seeing is game changing in South Africa, where the national infrastructure for energy generation generally has, other than the Southern Cape, generally broken down to more than it should have done recently. And so you're seeing decentralization of power, for which solar and low cost ability to set up low distributed solar plants are key. So I think this is all part of a tool with broader energy transition, because in Africa and Kenya we're seeing geothermal. If you look at what KenGen, the national energy company, is doing, you're seeing wind. So in relation to that, if you look at Ørsted, the Danish power company, 10 years ago it was a fossil fuel company, looking at now it's the key global leader on hydroelectric power, and they've totally transformed themselves. So I think we've got to look at it across the whole chain, really.
Great. I think, Neil, the questions what you had have been answered by sir. How effective are individual actions compared to corporate and governmental initiatives?
We all have to play a point. I often hear when I speak to individuals or friends and family, oh yeah, but I'm just a small part of this, so nothing I do makes a difference if the large industrial polluters or are polluting, and etc. But we're seeing genuine commitment for energy transition from even the oil companies that are invested into renewables. Of course, taking a very balanced view. We saw this with the Russian gas being switched off into Western Europe, where energy prices went through the roof, and it became uneconomic for us as consumers, and there's also a lack of supply. So we'd be naive to think we can switch off hydrocarbons and fossil fueled energy production tomorrow. So it has to be transitioned. But I spend a lot of time in the UAE, in Qatar, engagements in places like that, and there's a genuine desire to decarbonize and go green. There's oil companies realize they can't do it fast enough, so they're also buying renewable energy as well as investing into renewable energy projects, and then providing that along with carbon credits to their clients, because there's a number of use cases that we're engaged with in that regard. countries like Singapore that are big on oil and gas processing have a very, very concerted green policy on a number of fronts that's driven from government at the very top. So I think it's got to be a combination of actors. We always say, at Davos during the World Economic Forum, we said climate is all about collaboration of communities, of companies and countries. So the four C's come together, and that's very much the case and the need as we sit today.
Thank you for that. What tools and resources can help individuals track and reduce their carbon footprints?
Yeah, so there's some very, very good carbon calculation tools out there. Certainly, COP28, when we won the award as the best blockchain solution to scale climate finance, there were two other awards. One of which was for AI, and the other one was for IoT, Internet of Things. And there's a company called Evercom out of Singapore that won the IoT award, and they calculate scope 1, 2, and 3 emissions from clients. That's great, because when you integrate that with what we're doing at 013, that creates opportunities where companies that have emissions that they want to offset can then buy and settle those effectively, using what we offer. So this is about, collaboration coming together, because no one organization can do everything. The banks themselves are networks, the energy companies are networks in themselves. We are, and it's got to be a collaborative network of networks approach.
So a few questions on the global impact that I wanted to have little clarity from your side or your inputs on it. How can global cooperation enhance and create a unified and effective carbon pricing system?
Yeah, so it's interesting, because a number of years ago, for liquid asset classes, we took over-the-counter data and we took on exchange data and we combined them, because even today, everyone thinks of, let's say, FX options or interest rate swaps as liquid, but there are liquid points in the curve as well. And for that, you have to kind of extrapolate data, build out that forward curve, with highly credible assumptions as well, where feasible, and combining kind of one-off data with data that might be more standardized and more frequent. So I think, I was having this conversation just yesterday with an organization that did this in power markets and has a huge amount of solar data, combined with the data that we generate through the platform. Plus, we also know broadly where the market pricing is out there. So I think, you've got some indices out there like the S&P Platts indices, 5 of those, depending on the different buckets in terms of carbon credits. And certainly there's some early stage futures products on those, but certainly the market's at a nascent stage. And I think a lot of this is a combination of over-the-counter data, electronic data, combining that and combining data analytics, and then, for those assumptions, AI, and then, building better models that we can apply. And I think, we're beginning to see the early stages of that in terms of things beginning to develop, and we're going to see a lot of action in this space in the next 12 to 18 months for sure.
Okay. I think Neil has another pointer for you. I think, do you think the lack of supply could drive up inflation?
Yeah, so there is a good supply of, let's say, voluntary credits out there, but then you could argue a subset of those might be high integrity credits. So a bit like we looked at, to work with the issuer to create the structured product, we looked at 65 million carbon credits, but based on methodologies that then sort of garner the fact that they're high integrity credits, we cherry picked 4.3 million of them. So, and if you look at carbon removal credits, depending on different registries, but it's well under sub 5% of overall credits in the market. So certainly there's always going to be in some pockets excess demand compared to supply, and in some cases oversupply. More broadly, if you look at McKinsey and others, there is a strong prediction, the World Bank one that I mentioned, that the price of carbon credits overall is going to rise as our volumes, and there's a lot of work being done on standards and trusts being built on voluntary carbon credit side. So that is going to lead to upward pricing in terms of carbon credits, in my view, and in the view of those broader practitioners and organizations. I think that's a good thing as long as that distribution of wealth, given the points I made earlier, is going back to the projects and the developing nations that need that capital, because it can be used as a means of investment from nations that are buying to nations that need that developmental capital for climate finance. And that can only be a good thing, and that's where kind of the efficiency technology enablement can help in that kind of redistribution mechanism.
What are the best practices for ensuring carbon pricing mechanism is equitable and adjusted, and just particularly for vulnerable populations?
Yeah, so as we now do things on a platform, a bit like, if we look at what we can offer, all of a sudden you can access exchange platforms. Now, if there's liquid instruments, you can access an order book where supply and demand is very, very transparent. Where there needs to be price discovery, then there's an auction mechanism to establish pricing. And certainly, while Saudi Arabia had announced the world's largest auction in Kenya last year, it was manual. And certainly, we see no reason for those things to be manual, because we can digitally enable them, at the country level and also at the individual corporation level as well. And the tools exist to do it. And equally, we shouldn't forget the fact that 95% of the market is over the counter. So I need to negotiate with you. You need to negotiate with Neil, hypothetically speaking, and Neil needs to negotiate with Channel. And even the country activity is bilateral. This becomes many to many and like a spaghetti almost. And the ability now to run a distributed platform to then ensure kind of escrow, so that who delivers and who pays in a pre-funded market is addressed, is of paramount importance. And I think this is something we're big advocates of, and something that we're trying to kind of drive change in, and we're going to see more and more of that. And with that happening, you're going to see better price discovery, and you're also then going to see ultimately a better price, not just for verified carbon credits, but with the pricing and forward curve solutions that we mentioned that will likely come. You're also going to see forward credit finance come into the market to a greater extent as well.
How can technology advancements be leveraged to improve the efficiency and effectiveness of carbon markets on a larger scale, with all countries having their own plan for carbon markets?
Yeah, there'll always be individual networks. We speak about banks, brokers, and that's okay. And countries as well. Everyone says, "Oh, why should there be national registries at every country, or why does every country these days, many countries want to look to set up carbon exchanges?" We're saying, great. Let them have their own registry. That links to government policy and regulation, and there's obviously a revenue stream around that. And why shouldn't countries, their governments benefit from that? If used well, it can be used as an IMF debt reduction tool as well, and reduce the debt for these countries. And then development, if more capital is left, within countries in the community, incomes go up and GDP growth happens as well. Just taking a macro view. So we're of the view, yes, there should be many registries. That's fine. There could be ecosystems in each country. Much like we see with national stock exchanges, but then a hub and spoke model such as that we advocate will allow the interconnection of that kind of distributed, fragmented landscape. And this is where technology can really help, because we're all swimming in our own lanes where we're vertically swimming, but there's a real need to interconnect. Kenya wants to connect with Singapore, or Qatar wants to connect with Kenya. In turn, the UK wants to connect with Uganda. And ultimately, technology allows us to all to interconnect. But I'm shocked when I got into this market how much of it is manual and spreadsheet driven, which in this day and age, when we speak about AI, IoT, Internet of Things, blockchain, quantum computing, shouldn't be the case and doesn't need to be the case.
So with whatever pointers I had in mind for your clarifications, we have done with that pointers. I would like to summarize on what we discussed overly on the key pointers that we discussed. We discussed about decoding carbon pricing, how markets can drive environmental impact. And we spoke about future of carbon markets and innovation trend shaping sustainability. Carbon markets and you, where we spoke about how individual actions can contribute to global change. Some of the unanswered questions and global impact is what we discussed on technology and how global cooperation can bring in a pricing system is what we discussed. With this, we would like to conclude our show. Any last pointers that you want to add over here?
Yeah, and all I would say was, this is, climate change and action is down to all of us, and it doesn't necessarily have to just be a compliance cost. There are genuine opportunities out there, such as some of those we're advocating that can lead to commercial opportunities, lead to more investment, and make it economic as well. So I think, everyone looks at climate change and the compliance and the cost angle, but there are certainly revenue opportunities whilst we do good at the same time.
Okay. Okay. With this, I think thank you for joining our show. It was a pleasure having you on our show, Hirander sir. You can follow us on LinkedIn, YouTube, Facebook, Twitter, and Instagram. We hope that this discussion was valuable to you. And our next episode is on tomorrow, 107th episode on 19th June at 6:30 p.m. IST. And the topic is be the best you can see as a manager and a leader. Here, why? Looking forward to see you soon again. Good day. Bye for now. Thank you.
Thank you.